There are two tax systems in this country, not two sets of laws, the same laws applied to two completely different kinds of people. One system taxes you the moment you're paid. The other lets you decide when or if you get taxed at all. Guess which one you were taught to use. This isn't a video about loopholes or tricks the rich don't want you to know. It's simpler and more uncomfortable than that. The tax code isn't rigged in secret. It's published, public, and completely legal, and it was built line by line to reward one specific behavior: ownership. Everything else pays full price. If you earn a salary, your tax is calculated before you ever touch the money. It's withheld automatically. You don't choose the timing. You don't choose the rate. The government takes its share first, and you live on what's left. This is called earned income, and it's taxed at the highest rates in the entire system because there's nothing to negotiate. Your labor has already happened. There's no delay, no deferral, no discount for waiting. You traded time for money, and time doesn't come with tax advantages. Compare that to a bonus, overtime, or a second job, all taxed the same unforgiving way. The message embedded in the system is quiet but consistent. Working harder on its own was never the tax-efficient path. Now look at how ownership is taxed. If you own an asset, stock, property, a business, and its value grows, you own nothing until you sell. That gap between it grew and you owe tax is called unrealized gain, and it can last decades. Some owners never sell. They just borrow against the value instead, spend the loan, and never trigger a taxable event at all. When an asset is finally sold, if it was held over a year, it's taxed as a long-term capital gain, usually a lower rate than ordinary income, sometimes dramatically lower. The same dollar of profit taxed two different ways, depending on whether it came from your hours or your holdings. This isn't a loophole, it's the stated design. The tax code calls it an incentive for investment. Capital that sits still, waiting, gets rewarded for waiting. It's tempting to call this unfair, and emotionally it is, but structurally it's consistent. Every tax system in modern history taxes liquidity, money moving, more than it taxes patience. Earned income moves the moment it's created. Ownership income can sit untouched for years. The system isn't asking who has more money, it's asking who is willing to wait. Waiting requires something earners rarely have: a buffer. You can't hold an asset for 10 years if you need this month's paycheck to eat. Ownership's tax advantage isn't free. It's the reward for already having enough breathing room to be patient. Here's where it stops being abstract. You don't need a fortune to cross from one system to the other. You need one asset held with intention instead of zero. The moment you own something, even modestly, some portion of your financial life shifts from the earner's tax rules to the owner's. This is why invest what you can, even if it's small, isn't just motivational filler, it's a structural move. An retirement account growing untaxed until withdrawal, a brokerage account holding an index fund for over a year, a side business run through a structure that lets some expenses offset revenue before tax instead of after. None of these require wealth. They require a decision to stop being taxed exclusively as an earner. The people who stay entirely inside the earner's system aren't lazy or uninformed. They simply never made the one decision that moves even a small piece of their financial life into the other column. The tax code was never a conspiracy. It's a public rule book that rewards a specific learnable behavior and punishes its absence. Poor people pay taxes. Rich people pay themselves first, hold what they own, and let the system's own patience reward work in their favor. You don't need to be rich to start playing by the owner's rules. You need one thing and be willing to wait. Move in silence, build in silence, win in silence.